So let's actually talk a little bit about that. But John, I really wanted everybody to be able to hear your macro and top-down views of the world, because you do have so much experience. And what's so interesting about the markets right now, particularly the public markets, there's a lot of hedge fund managers out there who've probably never seen a bear market. So that's why I'm so excited to be able to bring your thoughts, right? Like, hello. And so anyway, having said that, how are you looking at the world? Because it is difficult to make these investments, and yet you have a private equity firm. So what are you doing?
Yes. Well, yes. So that's why I was saying it's the best of times and worst of times. So we raised a very large, at least for Canadian standards, a large growth private equity fund of $500 million US. It closed April the 13th. And we have screened almost 1,000 deals in about 10 months, which has been unbelievable velocity. We're about to close our first 2 deals, and neither of them are in the traditional tech space, largely due to the excessive valuations in that space. But the technology theme is a long-term theme that if you're not paying attention to or not investing along those lines, you are going to miss out. But you need to be smart about it. So the 2 investments that we are going to make are technology-enabled companies. Each one has a very strong business model. Oh, and by the way, this is a real novelty. They both make money right now, so
love it.
Quite unbelievable, huh? And I think making money in businesses that have economic value as opposed to growth at all costs, I think that's going to switch as well too. But looking at technology as a differentiator or as a moat, you don't have to be the producer of the technology, but you better leverage the technology in a way to make your business better, faster, greater, and having more customer insights. And so what we did, and it's tough, we stayed away from trying to chase valuations that were far beyond what we thought was an appropriate valuation range. Now, in this market, every asset is expensive. So you have to start off with that notion. And you're going to expect it to be at the upper end of your range. And once it's in the range, then it doesn't really matter if you're investing in a good company. So my advice to people is, when you determine what you think is an appropriate value and you kind of know what your limit is, know that you'll kind of get to your limit pretty quick, but then you're going to have to be disciplined because what people do forget about, with some exception, the entry point is extremely valuable in order to generate the requisite level of return. And in a market in 10 years where people have this perspective that, there is the greater fool theory, that someone will always be there to pay a higher price. Yeah, that's been going on and going on longer than I even thought. But when it stops really fast and really nastily. And I think that's what's going to happen, at least in certain parts of the value chain.
And so let me ask you, which parts do you think are most at risk?
Well, you're seeing the public markets starting to become very rational. So when you actually look at, say, in the last couple of years, all of the Canadian tech companies that went public in the last 2 years are below their IPO value. Some of them unbelievably below. In the US, I don't have the latest stats. I think it's 7 out of 10 are below their IPO value. Now, that includes a lot of SPACs, where that's been a disaster for a lot of the retail investors. So again, I just mentioned, Facebook, PayPal, et cetera, but there's numerous examples. Shopify, which is unbelievable, was down 50% from its highs. So there is some rationalization. Where you're going to see the real bloodshed, I think, is a lot of capital that went into late stage venture capital opportunities. And it was largely driven or fueled by a lot of what we call crossover funds. you said hedge funds, et cetera, that are not experts in the private markets and piled in capital at pretty insensitive valuations.
Mm-hmm.
And those values are tightly correlated to the public market valuations.
Right.
When those public market valuations have dropped, say on average 50%,